Okay, so now we are on corporate governance. Now, what you might notice in this reading, and some of you already know this, this is not a quantitative topic. Depending on your background and your interest, this might be very interesting or very dry. So, I actually think that if you, all of you are working now, and if you put your working hat on, the sort of material that you cover here is actually quite interesting. So it's easy, and what you will notice is that I'm going to be reading a lot of material, and I thought about this. So you might wonder what value is being added if I'm just reading material to you, and I thought about this too. In the past, I would just tell my students that you read this on your own because it's fairly straightforward. But then the value that I think that comes here is twofold. One is this material is being recorded. So the best use of your time would be you can take the MP4 file, download it on your mobile device, your smartphone or whatever gadget you hang out with, and on your commute to work you can just listen to this. That saves you a lot of time reading. So there are no graphs, no explanations. All you need to do is just hear these 35 points from this reading, and if you just listen to it a couple of times, you save a lot of reading time. So that's one point. The other point is just by listening to it, I also notice when I tell my students read it, most people don't read it till the very end, by which time there are 500 other things to worry about. So here at least you are forced to, you're a captive audience. Whether you like it or not, you are going to listen to all the corporate governance best practices. So consider it like forced learning, which you have signed up for, so I don't feel any sympathy. Okay, so first of all, let's start now. Introduction. What is corporate governance? A basic definition that you should know. Corporate governance is the system of principles, policies, procedures, responsibilities and accountabilities used by stakeholders to overcome the conflicts of interest inherent in a corporation. And we'll get into more details, but it's essentially a system of policies, procedures, etc. to overcome conflicts of interest. What are the things we'll do in this segment? We'll talk about objectives of corporate governance and the key attributes of a good corporate governance structure. What are the different forms of a business and the conflicts of interest that arise in each one of these forms? The major sources of governance problems, the standards and principles of corporate governance, some environmental, social and governance factors, and finally the impact of corporate governance on the valuation of an entity. Okay, section 2 now, the objectives and guiding principles. First, the major objectives of corporate governance should be: number 1, eliminate or mitigate conflicts of interest, particularly those between managers and shareholders. Okay, so that's the main objective. And the second objective is to ensure that company assets are used efficiently and productively and in the best interest of its investors and other stakeholders. Then the attributes, and these are self-evident, so I'm not giving any further explanation. You just need to learn these 2 bullets under objectives. Then under attributes, delineation of the rights of shareholders and other core stakeholders. So we need to know what the rights of shareholders are, what the rights of managers are, and so on. Clearly defined manager and director governance responsibilities to shareholders. Okay. Identifiable and measurable accountabilities for the performance of the responsibilities. Fairness and equitable treatment in all dealings between managers, directors and shareholders. And finally, complete transparency and accuracy in disclosures regarding operations, performance, risk and financial position. So these are the main attributes, and the rest of this lecture will be an elaboration of these. Section 3 then is what are the different forms of business. Many of you have probably seen this. There are 3 major forms: sole proprietorship, a partnership and a corporation, and this is simply table 1 from your curriculum. Okay, we'll just go through each one very quickly. In a sole proprietorship, there's a single owner. So I run a company, I'm the owner of that company. Any legal issues, very few. It's very easy to form a sole proprietorship. Legal distinction between owner and who runs the business, no, because the guy who owns it runs it. Liability is unlimited. What does this mean? This means that if I do some damage and somebody sues me, they can take my business and then they can also get into my personal assets. So the liability is very large. Ability to raise capital, very limited for obvious reasons. Transferability of ownership. If I want to sell half my company, that's very hard. So I might sell the entire company if people want to buy it. So there is a bit of a transferability issue. And owner expertise in business, obviously it's essential. You can't run the business until you have the relevant expertise. Partnership is simply an enhanced version of sole owner where you have multiple owners. Again, relatively easy to form. There is legal distinction between owners and business, not really. Liability, again, it's very high but shared amongst the owners. Limited ability to raise capital, ownership not transferable, and again expertise is essential. And finally, corporation, which is the one we are most interested in. So ownership, unlimited ownership, you can have millions of shareholders. Legal requirements, it takes a lot of legal paperwork, legal work to set up a corporation. There is a separation between owners and the people who run the business. So owners are the shareholders, the managers run the business. Liability is limited. So if the business does something that's wrong and is sued, the most it can lose is its assets. People can't go after the assets of the owners. Okay, ability to raise capital is very high. Easily transferable ownership, shares trade very easily on the stock market, and it's not necessary for the owner to have expertise in the business. So this looks very good, but what are the issues? The issues that most of corporate governance is based on is the agency problem, which is also called the principal agent problem, where the incentives of the managers are inherently at odds with the incentive of the owners or shareholders. Okay. Now, segment 4, what are the specific sources of conflict and what are the agency relationships? Now, you probably know this already, but just to set a context in your picture. So if you have this company and you have managers who are running this company and you have millions of shareholders who have a share in this company, the three major entities are the managers, the shareholders, and obviously if we have 1 million shareholders, it's hard for them to interact with the managers. So we have this entity in the middle which is called the directors or the board of directors. So the board of directors represent whom? They are supposed to represent the shareholders, and a lot of what we study in corporate governance is around these directors in terms of are they really representing the shareholders or not. If you feel that the directors are getting too close to managers, that's a problem. Okay, so you will keep seeing this concept of independent directors. Independent means independent of shareholders or independent of managers. It means independent of managers, and very often in large companies a problem is that the directors and managers are not independent. Okay, so if there are three entities, managers, directors and shareholders, the two kinds of conflicts that we'll talk about are between managers and directors and between managers and shareholders. So first let's talk about the manager-shareholder conflict. What are the inherent conflicts? The agent, who's the agent in this context? The agent is the managers. They might make the firm much larger than it needs to be without economic justification. You might have heard of large mergers where the economic justification was not there. But why do managers still go after large mergers to become a bigger company and so on? Bigger company means higher scale, higher pay scale, higher prestige and so on. So these happen all the time. Okay, what will a little shareholder do out of this? It's hard, but there is a conflict. Managers will go for bigger, because that means more salary, even if it's at the expense of shareholder value. Excessive compensation, perquisites, etc., so fancy offices, club membership does not add value to the shareholder, but it benefits the manager. Taking too much risk. So if a manager's compensation is based on a certain fixed amount, and then based on the company's stock price going through the roof, there is an incentive for the manager to take excessive risk, because if the risk pays off, he makes a ton of money. If the risk does not pay off, then he still makes his salary. So there might be an incentive for the manager to take more risk than he should be. Okay. Another scenario is where the manager could be taking some risk, but is so risk averse because he feels that if by any chance the risk doesn't pay off, then he gets fired. So the other possibility also exists where projects that he should be taking on, he doesn't, because he just doesn't want to rock the boat. Okay, so these are just 4 common examples of conflicts between manager and shareholder. And most of you probably won't read this unless it is forced on you, but I think examples in the curriculum are, I think it will take you a few minutes to read. I will read some of these with you, and I just think they're very interesting. The first one was Enron. That's a little longer, so that you read on your own. That's one of the best examples, and the reason I find this fascinating is in the 90s I did my MBA, and many of these cases here that we are learning about after the fact, about all the bad things they did, when I studied, they were cases of how good companies are run. So I just find it very amusing to come and, like, Enron was the star, imagine. So the problems were found out in the late 90s. So in the mid 90s, it was in an industry that is old and dying, and here is a company that has a stock price going through the roof, earnings going through the roof. So every MBA school was doing case studies on Enron. Okay, so I was in that cycle that was studying how Enron is so good. And similarly, companies like Tyco, so that you see over here. Now let's look at Tyco. This is hilarious. And so Tyco provides another well-known example. The earlier one, number 1, was Enron. So of a corporate governance failure. The CEO of Tyco used corporate funds to buy home decorating items, including a $17,000 traveling toilet box. Okay.
What's a traveling toilet box?
It's a traveling toilet, I don't know. A $445 pin cushion, $15,000 umbrella stand, and to top this all off, he borrowed money from the company's employee loan program to buy $270 million worth of yachts, art, jewelry, vacation estates. Then, in his capacity as CEO, he forgave all the loan. Okay. All told, the CEO may have looted the firm and thereby its shareholders of over 600 million. And when a case was filed against him, do you know what his defense was? He did not deny any of this. His defense was that it was not illegal, which might be a perfectly valid defense, but this shows clear example of huge corporate governance issues where the manager can effectively get away with taking so much money from the shareholders. So I just thought this example was good. And then a couple of other interesting ones. So this was another company that was one of my case studies in business school. An Italian firm, Parmalat, was one of the world's largest dairy food suppliers. So this is a Italian company, and you'd be amazed at the number of similarities between Italians and Pakistanis. Okay, the founder and top executive of Parmalat were accused of fictitiously reporting the existence of a 4.9 billion bank account so that the company's enormous liabilities would appear less daunting. So they showed higher assets so that compared to the assets, then even high liabilities would look small. Okay, by hiding the true financial condition of the firm, the executives were able to continue borrowing. Obviously, if a lender saw that this company already has very high debt in its structure, it would have a problem. But when it saw a 4.9, banks are willing to lend to you when you have a lot of money. Okay, so they tried to show that we have a lot of money. The fraud perpetrated by Parmalat's largest shareholders and executives hurt Parmalat's creditors as well. Actually, did I miss this? By hiding the true financial condition of the firm, the executives were able to continue borrowing. The fraud perpetrated by Parmalat's largest shareholders and executives hurt Parmalat's creditors as well as the shareholders. Why? Because obviously they could not generate profit for the shareholders, so the stock price fell. And then if the company assets lose so much value that equity is down to zero, once equity is down to zero, then can you go into negative equity? Yeah, because you get to a point then where the liabilities are more than the assets. And when liabilities are more than assets, then even the bondholders start losing out. So that's what happened. Parmalat eventually defaulted on a 185 million bond payment in 2003. So here they are showing 4.9 billion in their bank and they cannot pay off a 195 million bond. The reason I highlighted this after the previous example, in the previous example it's almost hilarious but maybe not illegal. So corporate governance failures can both be what you saw earlier, where you have high perquisites, like if an executive in Pakistan spends a very high amount of money getting membership to all the largest clubs or the best clubs, that would be a corporate governance failure, but it might not be illegal. Here with Parmalat, you have corporate governance failures where illegal things are also happening. And then this is also interesting. During the 90s, Adelphia, the fifth largest provider of the cable entertainment in the US, and the company's founders embarked on a aggressive, so this is the founders of the company, aggressive acquisition campaign to increase the size of the company. During this time, the size of Adelphia's debt more than tripled from 3.5 billion to 12.6 billion, so huge numbers. However, the founders were also arranged a 2.3 billion personal loan which Adelphia guaranteed. So just to help you understand the structure, and this happens a lot in the US, so you have a bunch of founders that start a firm and initially they might have say 50% of the company. As these guys start expanding and try to bring in shareholders, bondholders, let's say they go public. When they go public, then the founders might only be left with 20% of the company and 80% might be owned by other shareholders. But typically the founders might still be controlling the company in terms of trying to raise more money or whatever action. So the founders know a whole lot more about what's going on. So these are the founders slash managers. So they still happen to have 20% of the stake in the company, but 80% is owned by outside shareholders who don't know what's going on in the company. So this is the scenario here. So the founders also arranged a 2.3 billion personal loan which Adelphia guaranteed, but this arrangement was not fully disclosed to other stakeholders. So not fully disclosed essentially means that not disclosed. Okay, so the rest of the guys did not know that these founders have taken a $2.3 billion loan guaranteed by Adelphia. What does that mean? That if they do not, if the founders do not pay, then the company will pay. So this is also called a contingent liability of sorts, which might not show up on the balance sheet, but it's off balance sheet, and if bad times happen, then it's a loan that the company has to pay. Okay, so this is another huge corporate governance issue. In addition, it is alleged that fictitious transactions were recorded to boost accounting profits. So they might have some sister concerns or other related parties. With those related parties, they are doing these transactions to show high profits. These actions by Adelphia's owners, these are the original founders, were harmful to all of Adelphia's non-founder stakeholders, so all these guys, including investors and creditors. The company collapsed in bankruptcy in 2002. So what this is highlighting is if you have weak corporate governance, then the chances of collapse go up, and very often the largest or most common reason for companies completely collapsing are related to corporate governance issues, and that's why this is so critical. Okay, the other conflict is director-shareholder conflict. So directors are intermediaries between owners and managers. So there's a conflict if directors identify with managers' interests rather than shareholder. Okay, and how does this happen? If there is either a lack of independence because managers serve on companies' board, what this means is The CEO, the CFO, the Chief Operating Officer, who are all managers, are also on the board. So this is this a problem? It's a problem because then the board is obviously close to the management and not necessarily shareholders. Board members have personal relationships with the management, so either close personal friendship or maybe even related. Board members have consulting agreements with the company. So board member is doing these nice cushy consulting jobs. So somebody who is a retired executive from one bank is now on the board of XYZ bank, and XYZ bank is giving all sorts of high value consulting assignments to that guy on the board. Why is this an issue? Yeah, exactly. So if you are giving him a nice consulting job, he is less likely to find problems with what you as a manager are doing. So that's an issue. Interlinked boards, what does this mean? This means I am the CEO. So let's say there's company A and company B. So the CEO of company A is on the board of B, and the CEO of B is on the board of A. So this CEO says, I won't bother you. He says, you don't bother me. So we both take advantage. Okay, so this is also an issue. Directors are overcompensated. So if directors are paid more than what they should be for the work that they are doing, for the 2 meetings that they go to every year, if they are being paid $1 million, then clearly that's not right either. Okay. Yeah. So exactly. So the question is, large shareholders are on the board. So that would be a good thing, and we'll get into that. So if you have a large shareholder who's not part of management, so he's independent and he's on the board, that would be an ideal sort of board member to have. So you want people. So the question is, if management can somehow keep the large independent shareholder happy. A lot of what we are going to study now is from the context of an analyst who needs to be smart enough to try and evaluate whether that large 20% shareholder, whether he is actually acting in a manner independent, in an independent manner or not. So the next few, we have 20 pages of reading and scenarios like this come up. So the perspective of this reading is from that of an analyst, and I'm just actually going to come to this. So this is actually the meat of the reading, corporate governance evaluation. So an essential component of the analysis of a company and its risk is a view of the quality of its corporate governance system. This evaluation requires an assessment of issues relating to the board of directors, which is what we are talking about, and we'll discuss in more detail, managers and shareholders. So our perspective is, we are an analyst. We are looking at a company, and among other things, so obviously we look at their free cash flows and we might look at their strategic plan and so on, but it's almost extremely just as important to look at their corporate governance structure and see, what do we see as analysts, as financial analysts, what are we concerned with? We want to see whether the corporate governance model is favorable or investor friendly. Is it investor / shareholder friendly, or is it management friendly? That's the key question, and what we are going to see over the next several slides and comments is, how do we do that? Okay. Most of this is based on the board of directors. So the key point is, if you have a good independent board of directors, then other problems are essentially handled. So a lot of this reading in terms of your evaluation is focused on the board of directors. If your board of directors is weak and sort of very close to management, then you have a corporate governance disaster, because then management can do whatever, buy the $17,000 whatever portable or traveling toilet or whatever, but that can only happen if the board of directors is letting a guy get away with stuff like this. Okay. So that's why most of the next few slides are focused on the board of directors. In fact, I think there are like 10 slides, all section 5.1 focused on board of directors. So board of directors are a critical part of the system of checks and balances that lie at the heart of corporate governance systems. Board members, both individually and as a group, have a responsibility to, number one, establish corporate values and governance structures for the company to ensure that the business is conducted in an ethical, competent, fair and professional manner. Number two, ensure that all legal and regulatory requirements are met and complied with fully and in a timely fashion. Number 3, establish long-term strategic objectives for the company with a goal of ensuring that the best interests of shareholders come first and that the company's obligations to others are met in a timely and complete manner. So this is like the guiding principle. Now, a few more guiding principles and then we'll get to specific points. Board of directors should also establish lines of responsibility, system of accountability and performance management. So you need to be clear in terms of within the senior management at the company, what's the reporting structure, who's accountable for what, and then there should be performance measurement of the CEO, CFO, etc., all your key managers. The board of directors hire the CEO. Okay, they determine the compensation of the CEO, they need to evaluate the performance of the CEO. Board of directors must ensure that management provides board with sufficient information to monitor and evaluate the management. Board of directors should meet frequently enough to perform its duties. So there should be routine meetings, and in any annual report or SEC filings, you will see that there is an indication of how many meetings were held and who attended those meetings and so on. If you see very few meetings held, that's an indication that the board is not involved, which is a good sign or a bad sign? That's a bad sign. And board of directors should also be, they should have the appropriate training to adequately perform its duty. So if you are on the audit committee and you need to keep an eye on the financials, it doesn't make sense if you don't have the appropriate background and training and so on. Okay. Now this, again, it's a lot of reading, but you can be listening to this while you are traveling to work and so on. This is taken straight out of the Corporate Governance for Listed Companies, a manual for investors from the CFA Institute's book. So this is what investors should be looking for. And this is talking about board members. Board members have a duty to make decisions based on what ultimately is best for the long-term interests of shareholders. There has been much discussion in recent years about the needs for boards and management to balance the short-term operation of a company with a long-term sustainable strategic outlook. Although shareholders with a short holding period may indeed be interested in corporate governance, long-term shareholders, those that hold shares for years, are more likely to incorporate corporate governance factors into their investment analysis. The reason is that governance aspects often affect a company's value over a long time frame. To act in the best interest of shareholders, board members need a combination of 4 things, and this is critical: independence, experience, resources, and accurate information about the company's financial and operating position. So first, a board should be composed of at least a majority of independent board members. What do you think independent means? Yeah, apart from management, and there is more to it that we will get to, but at least first level you should know that they should be independent. With autonomy to act independently from management, rather than simply voting with management, board members should bring with them a commitment to take an unbiased approach in making decisions that will benefit the company and shareholders. Second, board members who have appropriate experience and expertise relevant to the company's business are best able to evaluate what is in the best interest of shareholders. So if you are sitting on the board of a software company like Oracle and you have no clue about software, obviously you are not at the right place. Or if you are sitting on the board of a bank and you don't know the ABC of banking, then again, you are probably there because you are friends with somebody rather than you are the right guy for the job. It's amazing how often it still happens though. Depending on the nature of the business, specialized expertise by at least some board members may be required. Now, it isn't always necessary that you should know everything about the business. So if you are on the audit committee of a software company, it's more important that you understand the financials, and then others might understand the business. Okay, third, internal mechanisms are needed to support the independent work of the board. Such mechanisms include the authority to hire the external auditor and other outside consultants without management's intervention or approval. This mechanism alone provides the board with the ability to obtain expert help in specialized areas, helps it to circumvent potential areas of conflict with management, and overall helps preserve the integrity of the board's independent oversight function. And finally, directors must have access to complete and accurate information about the financial position of the company and its underlying value drivers to enable them to steer the company in the best long-term interest of shareholders.